Navigating the economic symphony, the impact of macroeconomic factors on sector rotation strategies. Introduction. In the ever-evolving landscape of investment strategies, sector rotation stands out as a dynamic approach to portfolio management. At the heart of this strategy lies a keen understanding of macroeconomic factors, the overarching forces that shape the performance of entire sectors within the market. Unraveling the intricate dance between macroeconomics and sector rotation strategies requires a deep dive into the various economic elements that influence the ebb and flow of different industries. Macroeconomic factors as the maestros. Macroeconomic factors, ranging from interest rates and inflation to GDP growth and fiscal policies, act as the maestros orchestrating the movements of sectors within the financial markets. Investors employing sector rotation strategies recognize that each sector responds differently to these economic cues, creating opportunities for strategic reallocation of assets to capitalize on changing economic conditions. Interest rates and financial sector dynamics. One of the primary macroeconomic levers influencing sector rotation is the trajectory of interest rates. In a rising interest rate environment, financial sectors, particularly banking, tend to flourish. Higher interest rates can boost banks' net interest margins, enhancing their profitability. Consequently, investors may pivot towards financial stocks, anticipating robust performance as interest rates climb. Conversely, during periods of declining interest rates, sectors such as utilities and real estate may become more attractive. Lower borrowing costs can stimulate real estate activity, while the stable cash flow of utilities becomes comparatively more appealing in a low interest rate environment. Astute investors engaged in sector rotation strategies closely monitor interest rate trends to position their portfolios strategically. Economic expansion and cyclical sectors. The broader economic cycle plays a pivotal role in sector rotation strategies. During periods of economic expansion, cyclical sectors, such as industrials and materials, often outperform. These sectors are closely tied to economic growth, with increased demand for goods and raw materials driving their performance. Investors anticipating economic upswings may adjust their portfolios to include a higher allocation to cyclical sectors. Conversely, during economic downturns or recessions, defensive sectors like healthcare and consumer staples tend to exhibit resilience. These sectors provide essential goods and services that maintain demand even in challenging economic climates. Sector rotation strategies, attuned to macroeconomic indicators signaling economic contractions, may shift towards defensive sectors to mitigate risk. Inflation and the dance of consumer discretionary. Inflation, the subtle force eroding purchasing power, influences sector rotation dynamics, particularly within the realm of consumer discretionary stocks. When inflation is on the rise, sectors offering non-essential goods and services, such as entertainment and luxury items, may face headwinds as consumers tighten their belts. On the flip side, essential goods providers, like food and healthcare, may see increased demand. Investors engaging in sector rotation strategies monitor inflationary pressures, adjusting their portfolios to align with consumer spending patterns. By discerning the impact of inflation on different sectors, they position themselves to navigate the ever-changing landscape of consumer preferences. Global dynamics and emerging market opportunities. Macroeconomic factors extend beyond national borders, and global economic conditions significantly impact sector rotation strategies. Emerging markets, in particular, present unique opportunities and challenges tied to global economic trends. A burgeoning middle class, increased infrastructure spending, and technological advancements can propel sectors such as technology and consumer goods in emerging markets. Conversely, fluctuations in global commodity prices, geopolitical tensions, or currency volatility can introduce risks that affect sectors like energy and materials. Sector rotation strategies with a global perspective factor in these macroeconomic nuances. Seizing opportunities in emerging markets while mitigating risks associated with geopolitical and economic uncertainties. Government policies and regulatory impacts. Government policies and regulatory changes wield considerable influence over sector performance. Legislative decisions, tax reforms, or shifts in regulatory environments can create tailwinds or headwinds for specific industries. For instance, increased government spending on healthcare may benefit the healthcare sector, while stricter environmental regulations could impact energy and manufacturing sectors. Sector rotation strategies adeptly navigate the regulatory landscape, adjusting portfolios to align with changing policy dynamics. The ability to anticipate and adapt to government-driven shifts allows investors to stay ahead of the curve, capitalizing on opportunities and managing risks in a dynamic regulatory environment. Technological innovation and disruptive forces. In the era of rapid technological advancement, innovation serves as a transformative force in sector rotation strategies. Industries embracing technological disruption, such as the rise of electric vehicles or the adoption of artificial intelligence, can experience rapid growth. Investors incorporating technology-driven considerations into sector rotation strategies position themselves to harness the potential of innovation. Conversely, sectors slow to adapt to technological shifts may face challenges. Retail, for example, has witnessed a seismic shift with the rise of e-commerce. Sector rotation strategies attuned to technological trends may favor industries poised for growth through innovation while exercising caution in sectors vulnerable to disruption. Conclusion. In the symphony of sector rotation strategies, macroeconomic factors compose the overarching score, guiding the ebbs and flows of different industries within the market. Investors adept at deciphering the language of interest rates, economic cycles, inflation, global dynamics, government policies, and technological shifts can strategically position their portfolios. Sector rotation, as a dynamic and responsive investment approach, relies on the ability to anticipate and adapt to macroeconomic influences, allowing investors to navigate the ever-changing currents of the financial markets with finesse and foresight.